Right now, home prices are falling faster than they have in the last 4 decades. And a lot of analysts are saying that we're headed for the fastest decline in home prices that we've seen in the last 40 years. And on top of that, borrowing costs are going up faster than they have in the last 40 years. Bloomberg reported that the housing market has shifted from some of the fastest upward appreciation that we have seen in the last few years to the first drop in prices that we've seen since 2012. This was actually the fastest depreciation of home prices in the history of the S&P's Case-Shiller Index. And as borrowing costs, aka interest rates, continue to go up and the economy overall worsens, you can only imagine the pain in store for the housing market. And I'll try to go over exactly what we need to know. The experts told us not to call the recent dip in real estate price growth a crash. Median sale prices are simply leveling out to their pre-pandemic norms, they said. Well, a new report from Redfin is making that idea a much harder sell. Here's a data set from Redfin showing the U.S. housing markets that are cooling off the fastest. Number 1, Seattle, Washington, with a percentage change in price per square foot dropping to 17.7% year over year. Inventory up 114% year over year. The percentage change in price drop to 17.5%. Drop in pending sales, 22.5%. Number 2, Vegas, with a price per square foot down 14.5%, inventory up 89.5% year over year. In terms of price per square foot, you have San Jose down 17.6%, San Diego down 15.8%, Sacramento down 17%, Denver down 12.2%, Phoenix down 14.5%, and Oakland down 20%. Some of these, in terms of change of inventory, you're seeing 20, 30, 40, 50, even 100% change in inventory year over year. You're seeing a huge increase in inventory in these particular markets, a huge decline in buyers, equaling a substantial drop in price per square foot. This is just the beginning though. And in fact, most housing markets across the U.S. have held fairly stable. So far, what's starting to cool off first are the bubble markets. But eventually, as the rate hikes and monetary policy works its way through the economy, it's going to hit everything. According to Fortune, we're already starting to see home price declines in bubbly markets such as Austin, Boise, and Las Vegas. However, home price declines have yet to hit the entire country. According to Zillow, just 117 markets saw home price declines between May and August. In another 500 plus housing markets, prices are either flat or rose. Now, if you look at some of the official data that just came out, which lags behind the Redfin data, it's even more indicative. Across the board, you're seeing a drop, except for in East, North, Central, seeing huge drops in the Pacific, but in every market, it's either flat or going down and contracting. And this is the most recent data we have, but it is lagging behind. So imagine the August and September reports. Rates have gone up consistently since then. Things have gotten worse, and as we move forward and into 2023, things will get considerably bad. Real estate experts this time last year said that there's no way, no matter what the Fed does, that the housing market sees any kind of drop because of this big housing shortage. But what they didn't tell you was the massive demand shortage that the Fed is creating by killing all the buyers that would have been eligible to buy a lot of these houses by raising rates in the degree that they have and are planning to. And keep in mind, this is by design. It's a planned collapse. At the Fed meeting last week, Mr. Powell said he expects a correction in the housing market, a tough correction. What we need is supply and demand to get better aligned so that the housing prices go up at a reasonable level and at a reasonable pace, and that people can afford houses again. We probably in the housing market need to go through a correction to get that back in place. And the FOMC expect restrictive policy to continue for years. The longer the policy is in place, the more pain and the more prices have to drop. Now, the main argument against home price declines is that 85% of homeowners who have mortgages have a fixed rate far below today's level, a factor that could prompt most to stay put. And that does make sense if you have a locked-in mortgage at 3, 4, or even 5%. You're not going to sell your house and lose your low rate only to go buy another house for a 7% mortgage rate. Slim chance you want to do that, I'm thinking. And that is a limitation on supply. A lot of people are just going to be like, all right, I'm going to just hold on to my house. But you also have to remember that the same was true for these markets as well. And you're still seeing substantial inventory increases. And the reason for that is during the pandemic, inventory was so low that even if you double or triple inventory, it's really not that much, but still that has a huge impact on the price of houses. And even that aside, home prices are made up not just of supply, but also demand. And the Fed and Mr. Powell are doing basically whatever they can to kill demand. The rates are so high that you'd have to be a little crazy to take out a home loan right now, even if you can refinance 4 or 5 years from now. And if you're a cash buyer or willing to even pay these higher mortgage rates, you'd still wait until prices go back down to their pre-stimulated valuations. People aren't dumb enough or can even afford to pay high interest rates for low interest rate pumped valuations. Now, according to Ian Shepherdson, chief economist at Pantheon Macroeconomics, U.S. home prices might well be 15 to 20% overvalued. Indeed, over the past 4 months, single-family home listings have risen 40% while sales have sharply declined, meeting conditions for a potential market-wide pullback. And Goldman Sachs says brace for an even bigger housing market downturn. And in terms of a timeline, Mark Zandi from Moody's Analytics believes the housing market is already in a correction, which could increase home inventory as the volume in home sales declines. He said that there are 210 out of the top 400 housing markets across the country that are significantly overvalued and or overvalued by more than 25%. He said, I think this will play out over the next couple years, and it will be mid-decade by the time things finally bottom out. So listen, basically more than half of the entire U.S. housing market is significantly overvalued, 25%. Plus, he said it won't bottom out until mid-decade, so it's around 2025, 2026. All right, so to put it all together, they're basically saying as long as they're trying to fix inflation and make the dollar stronger, pretty much every other asset class relative to the dollar is going to get beaten like it stole something. And as long as the Fed is committed to years of monetary policy that's ending somewhere mid-decade, we should continue to see damage to asset prices. It's not all bad though, because even though we're headed for a hard landing, by the time that happens, inflation will be down significantly, and more than likely unemployment will be up, and then you'll see the Fed pivot, and you're going to see some amazing deals. But for right now, we got to grind and save some cash up to ensure you're in the position to take advantage of said deals when the time comes. Hence, that's why you need to hit my link and start learning a new skill and or gaining an edge to be successful in the markets and creating that independent stream of income, which is, by the way, recession proof. Anyways, my G's, that about does it. Don't forget to hit that sexy like button, sub, hit the bell, and get the hell over to my Patreon and Discord so you can gain that edge, brethren. Peace.